In the markets, there are people that want to take your money. They're on the other side of your trade, and their goal is the same as yours: make money. Now, some of these people already have billions of dollars. These are the guys that move the markets. They are the market makers. Now, that's what the Beat the Market Maker strategy is all about: understanding where the big money is and how to cash in on their action. In this video, we're going to show you exactly how to do that. All right, let's get to it. The Beat the Market Maker strategy, or BTMM for short, is a smart money concept developed by Steve Mauro. It's a strategy designed to align the trader with the market makers. Now, the market makers are the big dogs. They are the institutional capital, such as banks, governments, hedge funds, and whales. The idea of the BTMM strategy is simple: follow the big dogs and make money riding their coattails. All right, the Beat the Market Maker strategy is based on recognizing the patterns and tendencies of market makers and then finding profitable trades based on this information. Now, to do this, we use technical devices such as key levels, chart patterns, indicators, and volume information to make this determination of where the market makers are. From there, we make our decisions, we enter, and try to ride those coattails. All right, in addition to patterns and indicators, the three-phase cycle is a key part of the BTMM strategy. Let me show you what I mean. All right, here's a good look at the three-phase cycle. Very simple. Phase number one, the market makers drive a directional move in price. Phase number two, the retail traders step in. That leads to a rotational market conditions. And phase number three, the market makers return to take their profits. Always remember, the big dogs are going to get their money. Phase three is typically when they do it. They take the profits, and typically that can either end a trend, start a new trend, or really give you either a good sell-off or bump in pricing. Let me show you. All right, phase number one, you've got your directional move in price. US dollar, Japanese yen, 4-hour chart. You can see right here we've got a key level, previous day's low. We understand that that could either be a magnet or a support level. Let's have a look at what happens. Right there, you get the big sell-off. Price goes down, checks out the previous day's low. That's phase one. We go from what? About 143 up there to about 147. It's 230 pips. That's pretty good move. And then right here, previous day's lows, where the debate happens. That's when phase two develops. Retail steps in, leads to a rotational market. Doji, 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 doji. And then we see a bit of a sell-off, nowhere near the degree of the initial sell-off from the market makers. Now down in here, what happens? Phase number three begins to take hold. Profit taking. The market makers that were short from up here decided that they want to take their money. The big dogs always get their money. They take their money right there, and what happens? You see volume number one, volume picks up, drops off again, and then picks up. You see a change in the direction of price. So is this the end of the trend or the beginning of a new trend? A lot of times when the market makers get involved, it's both. It stops the prevailing trend and it brings about a new trend. So very simple three-phase cycle. Remember, the market makers drive a directional move. The retail traders step in. They fight over a value area. And then lastly, the big dogs come to get their money. Profit taking. Typically that brings about the end of a trend or a full-blown market reversal. Three-phase cycle. All right, let's take an example. Let's look at a few examples of how to trade the BTMM strategy. Okay, this is the failed auction strategy, and it really does play into the beat the market maker type of approach to the markets. The number one things market makers have is money. They have a lot of money. They can put in floors or ceilings in markets. Typically, they do this around key numbers. This is an example of a Euro USD daily chart where we see really just a textbook failed auction develop. So our key numbers are going to be our low, our previous day's low, or our previous day's high. And as you can see, this day, the bears were in complete control. They sold the market off. They tested the water slightly beneath the previous daily low. And then what do we have happen? Well, we had some bidders step in, more than likely market makers, and they established a floor in this market. This would be sort of a signal that you would want to buy into this market in anticipation of a bull run. So let's go ahead and use our market replay function, and you can see right here what happened. We got the big bullish day the next day. Why? Because the market makers stepped in right beneath that previous day's low, put a floor in. The retail sellers became exhausted. They bailed on it. They joined the buy. The market makers also joined the buy. You saw a bit of an uptick in your volumes, and what was the result? A bullish run. So that's an example of the failed auction strategy. Can be a very good way to trade reversals. Always be aware of your key levels, and if in fact price fails around those zones, you see an uptick in volume. That could signal that a reversal is coming. That's a pretty standard beat the market maker strategy. That's the failed auction. Okay, here's a breakout trade setup that incorporates many of the BTMM strategy concepts. So for the breakout, number one, the first thing we need is a key level, and the second thing we need is an extended period of consolidation. Right here we have our key level, which is an all-time high in gold made back on the 20 August 2024. Then we have about a 3-week period of consolidation where we have several repeated tests of that all-time high and failed auctions right above the previous day's high, and we just could not seem to get above that zone. That's a real strong signal that there's significant sellers dug in here to the short side of the market, both retail and institutional. It also is a very strong signal that there's going to be a significant number of stop losses right above that all-time high, and that institutional capital more than likely is going to pile onto this market if in fact we trade above our key level and break out of consolidation. So this is a textbook breakout. Anytime you see a key level with an extended period of consolidation, you should be considering potentially to take a breakout above the all-time high or above our key level. Why? Because institutional capital is going to pile on to those shorts being run. Essentially, it's a short squeeze. Let's go ahead and take a look at our replay function, and as you can see, we get the big robust 2-day break of almost 2.5% above our all-time high. So that's absolutely a fantastic example of a gold breakout trade that developed during the summer of 2024. Really a strong trade. Institutional capital piled on to the shorts, stop losses being run, and the resulting squeeze drove the market about $50 higher in just over 24 to 36 hours. Solid breakout trade there using a lot of those BTMM concepts. The Beat the Market Maker strategy is an advanced strategy. Finding where the market makers are trading can be very tricky, as institutional traders love to cover their tracks. However, understanding where the big dogs are likely to trade is absolutely invaluable when trading breakouts and reversals. Now, if you want to take a deeper dive into the BTMM, reference Smart Money Concepts and Steve Mauro's work. All right, thank you for watching. Feel free to subscribe and like if you like what you see. Okay, we'll see you on the next one.